What risks could company operating in foreign markets face? Goldfinch training workshop. What risks do you think European company may face in Russia? There are three main points which are worth mentioning to secure your company in our country. First, macroeconomic risks. Second, regulatory risk. And the third one is currency risk. Macroeconomic risk. Some risk, most often political in nature, which will certainly affect all businesses operating in the country and all types of assets at risk. It can also be caused by macroeconomic factors beyond the control of the government, such as levels of unemployment, interest rates, exchange rates, and commodity prices. So, some of the risk could influence much stronger on the specific sector of the market. Basic. What political risk the company could face? A government that pursues a policy of opposing foreign influence and interference. Then any company that is engaged in foreign investment or conducts operations within the country can face huge risk. After all, the government can deprive any foreign operations regardless of the industry. In general, the macro risk problem can be both short-term and long-term. Who the problem may concern? Financial planners, security dealers, and various investors. Protection. The protection against macro risk is insurance. Yes, this type of insurance against political risk to reduce possible losses exists. An example of a macro risk. For example, a problem with oil supply. Agreements with other countries may be cancelled and a large oil supply contract will be impossible to implement. Thereby, consumer countries will suffer because the supplier country will not be able to provide an order and thus collapse the huge chain of interaction between enterprises. Risks for investors. Investors also look at macro risk to assess political stability and overall investment growth of opportunities in other countries. Investors can take withdrawal actions related to the situation in the country or to the examination of a particular fund. And in order to make the macro risk of any particular investment more manageable from a portfolio perspective, it is necessary to diversify investments in a sufficient number of different markets. Currency risk. Currency risk refers to the losses that a financial transaction can incur due to fluctuations in the exchange rates of countries. That is, the attractiveness of the investment may decrease due to changes in the price proportions of the participating currencies. Currency risk. It occurs when cooperation takes place between countries with different national currencies. Any change in the exchange rate in the direction will affect the cash flow. This risk applies to investors trading on an international platform, but it is the companies for import and export of goods that are primarily at risk. If the contract specifies exact amounts and dates, and the exchange rate changes between the signing of the contract and the actual delivery, it will surely lead to losses for one of the parties. Terms. Buying a product from a company in another country, the price will be expressed in the seller's currency. It is related to financial reporting between the parent company and its subsidiary operating in another country. Forward-looking risk. This is the effect on the market value of the company due to fluctuations in foreign exchange rates. Protection. Companies exposed to currency risk may employ hedging strategies to reduce that risk. For example, you buy raw materials from Europe for your own production. You buy raw materials in euros, but now the exchange rate of the euro is 1:1. So for several months in a row, you buy raw materials for $100,000, and these costs are included in the cost of your goods or services. And if the euro has risen sharply, then your acquisition cost in dollars will increase. Although it will remain 100,000 euros in euros. So all your potential profit of your business is lost due to currency fluctuations. Regulatory risk. It is the risk that a change in laws and regulations will materially affect a security, business, sector of market. Changes in laws or regulations promulgated by a government or regulatory authority can increase the cost of doing business, reduce the attractiveness of investment, or alter the competitive environment of a given business. These changes could even ruin the business. Thus, government regulations could increase the cost of doing business or limit prospects for further growth, reducing profits and lowering the return of investment. The power of any government is to force business to operate within its boundaries, to comply with its laws. In this way, any business can face significant regulatory risk. Thanks. Does anyone have any questions?